Yes.
Okay, perfect. All right, so thanks very much for having me here. It's a pleasure to do this, to talk to this audience that has thought a lot about these issues, and to get some of your feedback on what we're doing. Let me just give you some motivation and tell you what we're trying to do before I get into the details. So the exercise I'm going to walk you through is one in which we're going to put down a model of a bank and estimate the franchise value of the bank. And we're going to estimate the franchise value using call report data for a large cross-section of banks in the US. And just to give you an idea of where we're headed, I think what we're after is measuring franchise value, and we're particularly interested in franchise value for medium and smaller banks, although we do it for all the banks in the system. Okay. So why is measuring franchise value an interesting exercise? Well, for one, if we just think back to a year ago with the failure of Silicon Valley Bank and other related banks, there's always this question that has been floating around, and in a sense has continued to float around, which is, were the factors that drove the banking stress primarily ones of liquidity, or were they ones of solvency? And I don't need to explain to you, but that's a critical question to sort out in any type of policy action with the banking system. There's a second question, which is almost a sub-question of that first question, which is the stress that hit the banking system was, to a large extent, driven by the large rise in interest rates from 2020 to 2023. And the large rise in interest rates led to stress. Does that mean that significantly large rises of interest rates will always lead to stress? And really, that's a question about what is the duration of the banking system of a bank? What's the interest rate exposure of the bank? So the two questions which we're going to try to address through the lens of figuring out franchise value is basically, what is franchise value, how high is franchise value, and how exposed is franchise value to changes in interest rates. Okay. So let me just step back. Picture on the left side here. This is a picture that I suspect many of you have seen. This is from the Zhang et al. Paper that was put out very shortly after the SVB stress. And it just computes for the cross-section of banks, the decline in value of securities across the banking system. And in total, that red line says that banks lost roughly $2 trillion in value from the rise in interest rates. So that is, of course, a stress point and a loss in value as a result of the rise in interest rates. Now, it's not determinate, it's an incomplete analysis. And what's incomplete there is that there's other factors that one might want to consider. And in particular, just pointing to what I have on the right side of the screen, there's been another line of argument that an important thing that offset the losses in securities is the franchise value of the banks. So Drexler, Savov, and Schnabel, or DSS for shorthand, have argued that there's another factor that is played out as interest rates rose, which is that the franchise value, the deposit franchise value, rose in value by on the order of 1.7 trillion. And if you sort of put the 1.7 and the 2, that suggests that solvency of the banks are mostly okay. So those are sort of two facts that we want to put on the table. I'm going to revisit these facts through the lens of franchise value, and I'm going to argue to you that the DSN analysis is correct for looking at the deposit franchise, but it misses an important aspect of the bank, which is the loan franchise. And if you put the two together, I'll show you that actually the franchise value, if anything, fell in value as rates rose rather than dropped in value. Okay, and I'll explain that part as I go through. Now, a second factor that has played into this question of franchise value is many people look at the DSS analysis, and I'm citing here a paper from JEPS by Andrew Metrick, and tie another observation to argue why banks maybe don't lose as much money when rates rise. And we all know that there's this deposit beta, it's less than 1. Deposit rates are inelastic to market spreads. So if you think about the stream of cash flows that comes from having a deposit rate that doesn't move one from one with market rates, that gives a bank a stream of basically 1 minus beta times R cash flows. And as Metric points out here, that's a source of value. That's a source of franchise value to deposits. Now, the second statement that's made here, I think, is the statement that we would take up, which is that when interest rates rise, the deposit spread increases, but it isn't the case that the franchise value goes up, right? I'm going to argue to you that cash flows go up, but the franchise value doesn't go up. And it's for a very simple reason, which is that as rates rise, although cash flows on deposit spreads rise, interest rates also rise. So if you market value the deposit franchise, I'm going to argue to you that it doesn't go up. And in fact, the deposit spread to a first order has roughly zero duration. Okay, so those are just some thoughts that I want to put out there, and I'm going to try to clarify this as I go through the analysis. Right? So just some high-level takeaways. Just following on the last point, I'm going to argue to you that sticky low beta deposits do not hedge interest rate risk. It isn't the case that as rates rose, the fact that a bank had a low beta deposit meant that it gained value to offset, say, security losses. In fact, I'm going to argue to you, and this is our measure, that for the median bank, in which franchise values arises from both deposits as well as loans, the duration of the bank value is positive, not negative. And then I'm going to go revisit the question as to what happens to the banking system as interest rates rose from 21 to 23, and I'm going to show you that securities, of course, fell in value by roughly 4.5% of assets. And I'm going to show you, because the duration of the banking system is positive for the median bank, that means a loss in franchise of roughly 1.5% of asset values. So there's sort of a double whammy rather than a hedge. Now, after saying that, there's another thing that we discovered in playing with the data, which is actually, even though it looks like those are two things that should decrease franchise value, there's another thing that's going on in the data, which is that the banks with the biggest security losses were banks with the highest initial franchise value. And that cross-sectional correlation has meant that if you look at the cross-section of banks, a large fraction of the banks still have remained long-run solvent, according to our metric. Okay, so I'm going to walk you through each of those pieces as I go through this talk. So I think that takes me past my first 10 minutes, if there's any questions as to where I'm going.
Do you see franchise value as a continuous, or at some point is kind of, there is a boundary when it becomes kind of 1 or 0,
Yeah, I understand. So I'll tell you, I'll clarify this as I go through, but I'll explain this in various ways. You should think of our measure of franchise value as basically an upper bound, no uncertainty value. Okay. I'll explain where that goes. I think, Jose, you're asking in the background, is it what happens in paths in which banks fail? Wouldn't franchise value disappear, and how does that affect today's franchise value? So I'll try to clarify that as I go forward. Yeah,
yeah, go ahead. Please, James.
Yeah, just clarifying question. What about the losses on the loan portfolio? So there's the franchise value of the, which I think you're thinking about, sort of fee income from future loans. But there's also just the fair value losses on the loans already on the balance sheet. Does that
absolutely?
Where does that figure into the?
We can put that in as well, and we have. It's I don't know if I'm showing it here in the slides, but we've also looked at that. I should account for that.
Thanks.
As well.
There is also a comment from Li Sheng Su. Li Sheng Su, would you like to speak up to say your question, please? Thank you.
Yeah. It's just the positive duration of the franchise value. Does that imply that the bank has a liability-sensitive interest rate profile?
Total. Again, let me clarify this as I go through, but that's going to be a key takeaway from us, that the median bank has a positive duration, and I'll explain to you exactly where that's coming from.
Okay, sounds good. Thank you.
Okay, So here's my plan. I'm going to walk you through a model, and then you'll see exactly what we're doing with the model. And then I'll take that model, and then I'm going to estimate the components of that model and the data. And the model you should think of as a valuation model for a bank, and I'll just roll it out for every bank that we have call report data. Okay. So here's the model of the bank. Assets, loans, securities, liabilities, deposits, some long-term debt, equity. I want you to think of the securities and the long-term debt at time of issuance or purchase as zero NPV. So no initial value. Think of this as like, you buy a mortgage-backed security of the market that's initially NPV zero. Of course, if interest rates rise, that might lead to gains and losses. But for starters, that's NPV zero. Where does value for the bank come? It comes from a loan franchise and a deposit franchise. So very simply, the deposit franchise comes from a quantity of deposits D, borrowing at interest rate RD, and potentially compared to the overnight Fed funds rate, effectively like the opportunity cost funds rate R star. That's a stream of cash flows going forward times a quantity of deposits that we're going to call the deposit part of the deposit franchise. On the lending side, bank makes L loans. RL is the lending rate that's potentially above the Fed funds rate. So there's a spread that the bank can earn off of that. We're going to call that part of the loan franchise. Okay, so in total, what is the franchise value? There's streams of cash flows going forward from spreads on deposits and spreads on loans. The present value of that stream is the deposit franchise. That's the thing which we're going to be interested in figuring out. Okay. As I said, we're interested in solvency. So let me also tell you how solvency and also liquidity fits into this analysis. The value of the bank, the value of equity, the solvency of a bank at any point in time is the book equity, the present value of the franchise, that's the PV S minus C term, as well as any mark-to-market gains or losses that you've had on your security portfolio since they were initially purchased. So as I said, think of the security purchase initially as zero NPV, but if interest rates rose or fall, you might get some mark-to-market gains or losses. Right? So the question of solvency that we've been faced with in the banking system is, we know that interest rates rose, so the mark-to-market on securities fell. Is it the case that the franchise value, the present value of the loan and deposit franchise rose to offset the losses in the security portfolio? So fundamentally, that's a question of what is the duration of this present value of the franchise, and that's what we're going to evaluate. Now, there's another consideration for banks that we often pay a lot of attention to, which is the liquidity position of the bank. So if the bank's liabilities were all came due and depositors all asked for their money back, what's the cash that the bank can raise? Well, it's basically the mark-to-market on its security portfolio, its loan portfolio, minus something like a haircut. And notice the present value of the franchise doesn't appear here because that's future value that that'll disappear if the bank is liquidated. So there's a liquidity risk concern, which potentially also looms for a bank that can create issues. And as lots of analysis of this situation has considered, you could have multiple equilibria in which a bank is solvent, but it's illiquid. And then because it's illiquid, if there's a run, you lose franchise value and then the bank becomes insolvent. Okay. What we're going to do, and I want to be very clear on this as I go forward, and I think maybe this answers was your 1-0 question, I'm going to ignore short-term run risk. We're only going to ask the question of what is the value of the franchise if there's no run risk ever. Right? And the simplest way to think about this is, and there's a collection of decisions we're going to be making in our valuation. In almost every decision we're going to make, we're going to get to an upper bound rather than a lower bound. So we're going to pretend we can value a bank. The bank's going to look like the current bank going forward. The bank will never be run on, so it'll always have its franchise. And in that scenario, we're going to compute what the value of the franchise is. All right, so more details on these things. I'm going to do separately the deposit franchise and then the loan franchise.
Can I quickly ask, like non-interest income and non-interest expense, like where do they figure into this?
Can I answer that question in a little while, James? I'll show you
Sure.
where they're going to pop up.
Thanks.
Okay. So let me do the deposit side, and then I'll do the loan side. Here's our model of the deposit side. Interest rate on deposits has some fixed spread, say to the Fed funds rate, 20 basis points below Fed funds, plus some loading on the Fed funds rate. That's the deposit beta that we're used to thinking about. We're going to estimate this basically bank by bank, these alpha Ds and these beta Ds. Imagine then that the bank can earn a spread off of paying this interest rate. What is the value of that spread? The deposit spread at any time is quantity of deposits times alpha D plus 1 minus beta times R star, right? I'm subtracting R star from RD, I'm subtracting RD from R star to arrive at this number. And so the 1 minus beta effectively is the extra bit you can get from having a low deposit beta. Let's value that spread. I'm going to call the floating value as ignore the alpha D. Suppose for a second that alpha D is 0. What is the value of the stream of cash flows that look like 1 minus beta R star? Well, it's this stream of cash flows. This is why we call it a floating value. This is the stream of cash flows from a floating rate bond. Okay. And as we all know, a floating rate bond always trades at par and has 0 duration. So that's very simply just divided the stream of cash flows by R star T, and you'll get 1 minus beta D. So the value of the beta factor that drives R star is a constant value that is just 1 minus beta D. And this is where cash flows and valuation have two different effects here. And this is related to the quote I gave from Andrew's Jeff's paper. It is the case that, of course, the cash flows will vary with R star, but value may not, because in valuing a bank, you have to discount at the R star as well. Okay, so deposit beta does not directly impact duration. That's sort of an obvious point, but I just want to make sure that that's understood. Let's do the next piece. I'm going to bring back the alpha D, and I'm going to suppose that it costs some CD per unit deposit to run the deposit franchise. Then what's the total value of the deposit franchise? It's the present value of this stream alpha, the 1 minus beta R star, and then minus the cost CD. You can break that up into two pieces. There's a fixed piece and a floating piece. The floating piece we've just talked about, it has constant value. It's 1 minus beta D. The fixed piece is the present value of cash flows alpha D minus CD going out there at a long maturity discount rate, what I'm going to call R infinity. Notice this cash flow is basically the cash flow in a fixed rate bond. So in the way we want to think about it, you can take a bank and split it up into a portfolio of fixed rate and floating rate bonds. And where I'm going to take you down in this valuation equation is I'm going to do this. I'm going to sort of systematically take a bank and call it a portfolio of fixed and floating rate bonds, and then just use simple finance logic, which is if I know the portfolio, I can value the portfolio, and therefore I will have the value of the franchise. Okay. So back to the deposit. The deposit franchise here now has a fixed rate bond and a floating rate bond. The floating rate bond has 0 duration. The duration of the fixed rate bond and depends entirely on whether alpha is bigger than C or whether C is bigger than alpha. Okay, so keep that in mind. So far, I've described the deposit rate as only dependent on, say, the overnight Fed funds rate. In practice, there's 2 bits of complication that we need to add in to more realistically capture variation in deposit interest expense. The first one is that some deposits are term deposits. And as a result, the deposit interest expense will not just depend on today's current Fed funds rate, but will depend on the interest rate that was contracted on when that term deposit was set. So that's what I've written up here. I've written, suppose a fraction lambda of your deposits are just overnight deposits with some deposit beta, and another fraction 1 minus lambda are term deposits with term cap T. In that case, the deposit interest expense coming from the term deposits will just reflect a weighted average of lagged term interest rates going back T periods. So we can just keep track of a moving average of past interest rates, and that'll tell us the loading on the term deposits. Now, let me also say that this lagged interest rate term deposit factor can also pick up another feature that we know is present with deposit interest rates, which is there's slow and lagged adjustments of interest rates. Interest rates rise, it takes a while for deposit rates to catch up. By introducing lags of term deposit rates, we're basically picking that up. That is, reset happens more slowly as deposits roll off and new interest rates are contracted on. That's very similar to a slow adjustment of rates. So these two factors captures, I think, two things that are relevant for thinking about deposit interest expense. All right, so just rewriting this expression RD, I'm going to do the following thing. I'm going to take the term lagged interest rate Y, subtract from it R star, which is the Fed funds rate. And if you think about this cash flow Y minus R star, that's basically the cash flow on an interest rate swap. It's a cash flow on a lagged interest rate swap that was contracted on T periods ago. And then if I take that R star and I move it over in with the left-hand side with the overnight deposits, you get sort of a modified beta that loads on R star. Okay, so this is what we're going to do. We're going to model the deposit rate as having a fixed piece, a piece that loads on R star. There's a deposit beta here. This deposit beta is now a hybrid of a deposit beta on short-term deposits as well as term deposits. And there's a 1 minus lambda loading on a bunch of lagged interest rate swaps that reflects lagged adjustment in interest rates as well as term deposits. Okay, as I'll show you in the data, having this lagged adjustment and these term deposits is pretty important in capturing variation in deposit interest expense. Some of you probably already know that, but it's going to be important, and that's why we put this in. So let's value the deposit franchise now with all of these pieces. It's logically the same thing as what we had before, so that's the deposit spread. I'm going to define little d as deposits over total assets. I'm going to scale everything by assets in what follows. So little s is total spread divided by total assets. What is that? It's little d times the alpha, the fixed piece. It's another piece that loads on R star. And it's a piece that loads on these lagged term swaps. Let me define each of these three pieces as phi naught d, phi 1d, and phi td, where cap t here reflects the term. I can value each of those three pieces separately. They're again just a portfolio of assets. The first piece of that portfolio is a fixed rate bond. The second piece of that portfolio is a floating rate bond. And the last piece of that portfolio is a portfolio of lagged interest rate swaps. We can value this exactly and figure out where duration lies. Again, I'm just going to point out, where does duration lie on this deposit franchise? It lies on phi naught minus c, the fixed spread piece, and there's a little bit of duration sitting here on the term swaps. Although magnitude-wise, this is going to be small when we go to the data. We can do the loan side very similarly. So let's think of the loan rate as having a markup over the Fed funds rate alpha L, plus some loading that could reflect, say, floating rate loans, beta times R star, plus another loading that could reflect term loans, maybe 5-year loans or 2-year loans, that also reflects something like loading on past interest rates. I can do the same exercise I did with the deposit side and construct another collection of fees for the loan side. And then the value, the franchise value of the bank, then is just the sum of these two things. It's the sum of the deposit franchise and the loan franchise. And the way we've described it is it's really just the sum of three portfolios. A first portfolio, which looks like a fixed rate spread. And if you just look under the cover, what is this phi naught? That phi naught is the alpha L here on the loan side. It's also the alpha naught D on the deposit side, and it's the CD on running the bank's deposit franchise. So the sum of all that is a fixed leg of running a bank, which looks like a fixed rate bond. There's a phi 1 here. That's reflecting all of the floating rate, all the stuff that's loading just on R star. That's the floating rate bond part of it. And then there's a phi T loading on a bunch of interest rate swaps, lagged interest rate swaps, that we also have to take account for. As I said, we're just going to value this, and that's the value of the deposit franchise. I'll show you as we go forward. This stuff is pretty small here in terms of value as well as duration. And magnitude-wise, the value of the deposit, the duration of that franchise is all going to load on whether phi naught is bigger than C or phi naught is less than C. Okay? And for those of you who know the DSS work, basically what they have done is they have a phi naught that's 0, and so that they get a loading on the deposit franchise that gets you a negative duration because C is obviously bigger than 0. Okay, that's the valuation model. I'm going to next take us through data and then estimate the pieces of this valuation model.
I have a small question, if you don't mind, Arvind.
Yeah.
Do you think, is there an optimal threshold of low deposit beta or stickiness that minimizes duration risk, or is there a point where the risk-return trade-off no longer holds? That's one question. Another question I had is, can your model potentially integrate transaction costs or adjustment frictions that banks may face when changing security holdings in response to rate shifts, which could potentially affect duration?
Okay, so on the first question, I mean, there's two aspects to your question, Raluca. One is, and again, I want to emphasize this, the way we're looking at the deposit franchise, it is the case that because the beta is low, cash flows on the profits off of the deposit franchise, that is R minus beta R, will vary with interest rates, but the present value of that will not, because you're present valuing at new market interest rates. So there's no duration off of the deposit franchise in terms of its low deposit beta. And I think that's true both at high interest rates as well as low interest rates.
Okay, thank you.
There's one issue that one could be worried about, which is maybe the deposit beta. In the model that I've written down, I've written a linear beta model, right? And maybe, Raluca, this is what you're asking about. We sort of know from data that the deposit beta can depend on the level of rates. Like, for example, when rates were closer to the ZLB, the deposit beta might be different. And so that's a thing that we need to think about that may not fit the model I've written down. I'm going to show you that is true. That's a fact in the data, but it's a magnitudes-wise, it's so small that it's not going to affect valuation very much.
Sounds good.
And then the second question you're asking, I think, is could it be the case that costs, I mean, you said transaction costs,
Right.
But let me just say more generally, suppose this cost C depended on interest rates in some systematic way. You know, maybe the cost of running a bank could also vary with interest rates. In that case, you'd get a dependence of costs on interest rates. And of course, that will then change the duration of the bank because now you have a stream of cash flows that depend on interest rates. So that is a relevant and salient concern that one could think about. We've in our look at the data, and you can see this in the paper, and I don't think I have it on the slides. We measure costs bank by bank and in aggregate, and they don't look like the loading on interest rates historically is very high. So to a large extent, there's very little dependence on interest rates of these costs, so that I think it's safe to call this more like a fixed rate bond than a floating rate bond. But again, that's an open question. It's an empirical question. I could imagine for some banks that there's more loading of C on R, in which case the right model would be to write C of R and then value the bank that way.
Sounds good. Thank you so much for your responses. I think we have another question in the chat from Beverly Hirtle. Beverly, would you like to say your question?
Sure. I just wondered in the valuation, this goes back a couple slides now, where you basically say you're valuing at the market rate. I wondered if you needed to think about a credit spread, at least for uninsured deposits, such that they might not, you're sort of modeling it on the risk-free rate and then discounting it at the risk-free rate, if I understand correctly what the formula is. Yeah. That I think that's exactly right. I'm valuing it at the risk-free rate, and I'm discounted at the risk-free rate. Now, Bev, I have an alpha D here. Right. I think one can think of the profits from the deposit spread as having a fixed component and a component that loads on interest rates. When I say that
that the floating rate part of the deposit side has 0 duration, what I'm doing is I'm sort of stripping it into 2 separate pieces and saying that the part that only depends on, that loads on R star is what I can wash out and call that a floating rate bond, right? So there's other pieces here that could potentially change the calculus, which is, for example, the fixed spread. I hope that.
Yeah, I mean, I guess in some sense, if credit spreads also vary over the interest rate cycle, assuming something that's fixed, even the alpha D might not quite capture it. And there are very significant differences across banks in the share of uninsured deposits, which has also changed over time for the industry as a whole. So, just thinking about the, we don't like to think about the credit risk of deposits, but there is some.
No, absolutely. So again, as I said, the portfolio approach allows us to handle that, right? What you've just told me is that for each banks, the alpha and the beta might vary across banks. And you've also told me it's probably changed over time. But that still fits into this valuation model in the sense that if there's a component of the deposit spread that you just have to pay a higher than R star rate on uninsured deposits, I'm just going to put that into the alpha D. There's still going to be a component that'll vary with the interest rate R star, and I'm just going to keep that in the R star. So I can keep track of both of these two things, and I can handle both of them, in a consistent way in this model. And it'll just be a question of what are the alphas and what are the betas.
Arvind, can I ask one last question about the framework? I think you partially answered it already, but you mentioned that DSS basically don't have a fee or have a fee of 0.
Yeah.
And that's because they don't model the loan franchise at all, right? So that sets that to 0. And then for the deposit franchise, I guess they are assuming that as you get to since we've observed going to the 0 lower bound, that deposit rates basically go to 0 and the spread almost goes away, that there isn't really an alpha D, or that alpha D is 0 in their thinking.
It's I think that's right. The alpha D is basically 0 in there. So what the alpha that's going to show up in our analysis is going to be an alpha on the loan side.
Mm-hmm. Okay.
That's actually where the significant piece will show up. There's another source of difference that I haven't put on the slides. It's in the paper between what DSS is doing and what we're doing. And this is also kind of important, which is they assume that the deposit franchise declines over time. That the cohort of deposits that you have currently on which you're making profits will decline at some rate over time. And what that basically does is the declining deposit franchise ends up acting like a short duration liability. Right? I mean, like in the extreme, suppose I told you that all your deposits will disappear in 2 years. That's basically like saying you have a 2-year liability outstanding. What we've done here is we've actually put 0 growth. We actually think that the right approach is to put positive growth. That is, deposits in the banking system on average grow rather than shrink. So the right model one should do for valuation purposes is growth, which will affect both valuation as well as the implicit duration of the bank, because you'll have income deposits over time, and that'll be a continuing source of franchise value going forward. But I don't want to go too far off field because I don't have it in my slides, but what we're going to do is we're going to set growth of 0, but that is another difference between us and DSS.
Okay, thanks.
Okay, let me walk us through data. So I'm going to use call report data. I already mentioned this. We're going to do one screen is which we're going to drop banks which obtain more than 30% of their income from credit cards. And we exclude the very smallest banks. We're going to do basically kind of a check of the model. As I said, most of the analysis is really, you should think of as small and medium-sized banks. But for the largest banks and for some of even the medium-sized banks that are publicly traded, we have equity prices, and we can just do a market to book from our model and compare it to what the stock market thinks. Okay. We need to measure deposit spreads and loan spreads in the data. And so this is the way what we're going to do. We're just going to do this very simply. RD is interest expense on deposits divided by deposits. RL is interest income on loans divided by L. We need to do an adjustment for potential credit losses on loans. And so the way we do that is we just measure credit loss provisions per loan and then gross that up by basically a risk adjustment, a Q over P that we pick out from the corporate bond literature. And so that gets us a default risk adjusted interest income on loans. So that's the RL measure, which we'll have. And as I said, we'll do this bank by bank in the time series. And then we can just construct spreads analogously as R star, the Fed funds rate minus RD, and RL relative to R star. We need to measure costs. I think this connects to a question that maybe James asked earlier. What do we do with costs? We're going to measure the usual things for costs, expenses, some non-interest expenses. And then we have to do a couple of adjustments. So deposit service charges, which is in some sense fee income, we're going to not call that income. We're going to call that as a reduction in costs. There's a similar thing we do for credit cards. There's credit card fee income. We've done a screen to drop out the largest banks, but there's still plenty of credit card income in there. We're going to call that fee income, and we're going to subtract that off from costs. And then the other adjustment, which is actually probably the more significant adjustment, is there's a bunch of banks, especially some of the larger banks, which have other sources of business income other than lending and deposit taking, things like brokerage. And what we have done is we've taken the full cross-section of banks, measured other business income in the cross-section of banks, projected that on franchise costs, on costs of running a bank, and then deducted a portion of costs associated with other business income, and then eliminated other business income completely. Okay, so that's sort of a way of trying to strip out the brokerage business out of the banking business. That's what I'm going to show you. There's another robustness check which we've done in the paper. We just excluded all banks with a significant amount of other business income and used a screen approach rather than what effectively is a regression approach to adjusting costs. Okay, here's what our spreads look like. That's the blue line's deposit spread. The red line is lending spread. I think this should all look very familiar. There's an interest rate cycle. It's showing up in both of these two things. Put those two things together. The total, sorry, I should have told you, this is for the aggregate banking system. I'm just using this as motivation for where we're going to go. I'm mostly focused on the cross-section of banks, but this is just to fix ideas on what we're doing. The red line is the total spread, the sum of the lending and the deposit spread. And there's some variation of that with interest rates. I'll show you this in a regression in a second. The blue line here is franchise costs. And you can see the ZLB period in where costs were basically beating spreads. And this is cash flow negative over there, of course. And this is important for valuation. The yield curve is upward sloping, which means the markets expected cash flows to eventually grow as rates went up, and then potentially beating franchise costs. And so for valuation purposes, you need to account for that when you do solvency analysis, and which we are doing implicitly in the model which we have. Here, this is aggregate data of the deposit spread fit. So deposit spread fit is, again, Fed funds rate minus deposit rate. That's the blue line in this figure. If I just project on Fed funds using a linear beta model, that's the red line, you can see it works, but not so great. The type of things that you worry about, which I know the literature has paid attention to, is if you look at, say, at the recent period when interest rates rose, deposit rates didn't rise as much, and then they started rising later when interest rates rose more. That makes you think that the deposit beta is nonlinear. And there's definitely some evidence of that. On the other hand, if we put the Fed funds rate as well as this term swaps, these lagged term deposit rates, into our fitted line for the regression, that's the green curve here, we get much closer to the blue line. There's still a little bit of gap, but we get much closer to the blue line. And that's just a way of saying that the slow adjustment of deposit beta actually masks something else that's going on. The other thing that's going on is term swaps and rates are adjusting slowly. And if you just account for that, you'll pick up the slow adjustment of deposit rates directly with that, even with the linear beta model. We can do the same thing on the loan spread side. The actual line is in blue. The green is our full fit. The red is just fitting on the Fed funds rate. If you just fit the loan spread on the Fed funds rate, you do a pretty poor job. Adding the term swaps is pretty important in an R-squared sense for capturing this. And that's just reflecting the fact that most loans are not overnight floating rate loans. They're looking like 2-year loans or 5-year loans. And so adding these term swap adjustments is important for picking up maturity on the loan side. Let me show you just regression, what this looks like. So if you look at the deposit side, if you just project deposit spreads on the Fed funds rate, that's effective. That's in our language, that's like 1 minus deposit beta. You get an R-squared of 79%. If you project on both the Fed funds rate as well as 2-year swaps and lagged 5-year swaps, your R-squared goes up to 95%. And this is what's important for us, which is when we add these term swaps, we get very high R-squares. And this is also true in the cross-section. When we add the term swaps, we get R-squares of around 95%, which is to say we're capturing most of the variation in the deposit spread. So even though we have a pretty simple linear model, we do a pretty good job. And if there's any nonlinear effects, it all shows up in the last little 5%. On the lending side, there's something similar. There's a loading on the overnight Fed funds rate. It's pretty small. There's loading on 2-year loans, on 2-year swaps and 5-year swaps. That's basically telling you that there's a component of the loan side which looks like 2-year loans and another component that looks like 5-year loans. If you add all of these pieces together, you get a loading on the Fed funds rate, the overnight rate, and you get a loading on the 2-year and the 5-year. The loadings in the 2-year and 5 years are smaller than the loadings respectively in the deposit and the lending side because there's some offset on both sides. Okay, so effectively, there's some deposit product that looks like a longer term deposit product, and there's some lending product that looks like longer term lending product. And those two durations roughly offset each other so that you get closer to zeros when you put these two things together in the 2 and 5 side. So that's the sense in which I told you the term swap piece, although it's important in capturing the dynamics of both deposit rates and lending rates, when you sort of sum them across each other, they roughly offset each other so that it has a small contribution both on value as well as on duration. Okay, so most of the action actually shows up just in what is now a composite deposit beta and a loan beta, this 0.18 number. The other thing that I want to highlight for you is this intercept, which you should read as 60 basis points. That's the alpha D plus alpha L of the bank. Okay. So that looks like a 60 basis point positive value going forward. And you should compare that, and this is for the aggregate banking system, to costs of running between 1.5% and 2%. So for the whole banking system, 60 is less than the total costs. Let me show you, though, what happens when you look at the cross-section of banks. So this is the same thing that I'm running now. I'm running it for the entire cross-section of banks. And I'm just going to focus in on the total spread now. And let me look at P50. So that's the median bank in the cross-section. The phi naught, which is the total alpha D plus alpha L, is 2%, right? And this is why I told you before that's now for the median bank that's beating the costs. And I'll show this to you more precisely in the next few slides. There's a loading on there's a floating rate bond component to the bank. That's these loadings are actually very similar to the aggregate numbers. What changes most is the fixed spread. And I think the way we've come to think about this is that the aggregate banking system is dominated by large banks, which are getting income from other sources, like other sources of business income that's not just lending and deposit side. For the median bank, there's a significant amount of income. And if you look under the hood, most of it is coming actually from the loan side, that the banks are making some spread off of the lending product. Okay, and so that's the sense in which we got to account for that when you account for the duration of the franchise. Here's a table that we were concerned about, and I just want to show you that I feel we're comfortable with. So, we know that deposit rates have The deposit beta has some convexity in it. We also know that there's asymmetric adjustments of deposit rates with respect to market rates. Here's just a regression where I allow for possibly nonlinear effects off of market rates, possibly asymmetric effects off of increases in rates as well as decreases in rates. These stars indicate that they're important. They are an important component of modeling deposit rates. But I want to pull you down to the R squares, which is telling you that the R squares don't change very much when you just project on the Fed funds rate to when you add these extra pieces. So largely, the simple linear beta model captures most of the variation in interest rates. There are other pieces, but in terms of thinking about this now as a portfolio of assets, these other nonlinear pieces, which basically look like options, are roughly small quantities of options so that they won't change valuation very much, right? This for us was compelling a reason to ignore some of these other things that I know that the banking literature has spent a lot of time thinking about. All right, so let me then come to our franchise value estimates. We have basically all the pieces for all the banks for which we can compute franchise value, and that's franchise value is this thing down in the bottom. It's the value of the fixed piece, the floating rate bond, and then the term swaps. Again, I'm just going to show this to you, say for the median bank. The median bank has a fee naught that slightly exceeds costs, which means that for the median bank, they have a fee naught that's bigger than C. So that looks like a fixed rate bond going out to infinity. They have a big piece, which looks like the floating rate bond, fee 1. And then they have some swaps, but as I told you, on the deposit side and the loan side, they roughly offset each other. So this term actually ends up being quite small. On the right-hand side here, I've just broken down the fixed rate bond portfolio and the floating rate bond portfolio of the entire bank franchise. Plotted across the x-axis here is total assets. And what you can see here is in terms of value, most of the value for the banks is coming from the floating rate piece, which you should think of as coming from having a low deposit beta. There's value coming from the fixed rate piece, but it's smaller. But of course, for duration purposes, it's exactly the opposite. All the duration comes from the red rather than the blue. That's what's going to be important for understanding changes in franchise value as rates have risen. The only other thing I point out is if you look at the largest banks here, it's these blue dots, these red dots, they don't look the same as most of the banks. And if you look at the smallest banks, they also look off. Right? So in some sense, the smallest and the largest banks have slightly different business models than much of the banking system that sits in the middle. And as I said, most of what we're after is the median bank, the guy in the middle. Here is for the banks that are publicly traded, we have a value of the franchise. I can compute an asset market to book based upon our model, and I can compare it to market value market to book in 2021. That's what this graph is. In an ideal world, this is a 45-degree line. It's not, but it's not too far off. So this is one check that our model is not a crazy model. It's roughly in the ballpark of what markets think. Here's another way of looking at the model. We can use in our model what happens when interest rates rise from 21 to 23. What does the franchise value of the banking system change by? That's this black set of black lines here. That's our estimate of the change in franchise value going from 21 to 23. This is again for the publicly traded banks. The blue line here is market value changes from 21 to 23. And we're not too far off, but I should have also said this before I walked you through this graph. The x-axis here is security duration on the security portfolio. And the reason we're doing that is because to a large extent, the losses in the banking system were losses on the security book. And so we're using that as the x-axis to sort across banks. So it looks like banks with more security exposure lost more money on assets according to market values, as well as our estimate based upon our franchise value estimate. There's differences here, but we're sort of in the ballpark. I want to show you one other thing, which is also just worth noting. This is the red line here is from the bank's 10Ks on their answers to the question of what would happen to our equity value if interest rates shifted up by 1%. And I just want you to notice that for most banks, that number is positive. Most banks thought that if rates rise, they would gain value. Blue, which is markets, said that's not right. Our black, which is our valuation model, also says that's not right. So, one success here is at least we're beating what the banks themselves think about value. So I want to just come back to the duration question. So, we know that one of the things that has happened in the banking system is banks loaded up on holding securities and holding duration. Sorry, I see a question here. Let me pause.
James, please.
Yeah, I was just going to say there's like a dynamic aspect to this, right? Which is that the bank's estimate of the local DV01 in 2021 is not the same as what actually happened because of these nonlinearities, right? So like, I mean, you talked about the nonlinearity on the deposit side, that the deposit beta's got some convexity in it. But then on the asset side, they're holding a lot of agency MBS.
Yeah, which has
the agency MBS extend, right? So I wouldn't necessarily assume. If you look at these, all
right,
these
I agree with
banks,
you, James. I'm just going to say one is positive and one is negative. That's all I want to put out here.
Sure, but if you look at those numbers for 2022 and 2023 for banks, they look very different to this. So you shouldn't necessarily.
So you're saying if I did what I did in red again for 21, 22, I would get different looking estimates?
Yeah, or if you did it, or I mean, I don't know what the data would say for 2021 if you looked at a larger shock. I'm just sort of saying, like, they won't necessarily look the same.
Right,
even so directionally, they won't necessarily look the same.
We can definitely do this. I mean, we've basically taken two endpoints of the interest rate cycle, 21 and 23, but we could do this quarterly across every point in time there and see how close we are.
Yeah, that'd be a very interesting exercise.
Yeah. Okay, I want to come back to hedging, security portfolio, what banks do and what banks maybe should do. Okay. My characterization of a bank is fixed rate bonds coming from phi naught minus C, floating rate bonds coming from basically a deposit beta and some term swaps. If you're hedging value, what you should do is you should go out and short more securities if you have a higher fixed rate bond portfolio that comes from your lending and your deposit side. So that is, if your phi naught minus C is a high, if you're a bank with a high phi naught minus C, you should have less securities. Okay, so we can just regress in the data the bank's securities duration holdings against the fixed value, and you see a negative sign here. So that's sort of roughly correct, but the R squared is really tiny. If you project bank's duration on the floating component, effectively a deposit beta, you get a much, much higher R squared. So just empirically, it looks like bank security holdings are more correlated with their deposit beta than their fixed piece. And to us, that seems an odd thing if you're concerned about value, because the floating value is a floating value. It should be zero duration. You shouldn't be hedging based upon your exposure to floating. You can see this in the cross-section of banks. This is our floating sensitivity of total spread, which is basically like 1 minus deposit beta. That explains the security duration of the banks pretty well. And I just want to put that out there. That looks odd to us. It looks like what banks are doing with their security portfolio is their cash flow hedging rather than value hedging. And I know I'm running low on time here, so I'll just leave you with that as a fact that we may need to discuss. I want to come back now, and I think we have all the pieces to evaluate the following question, which is banks lost a lot of money on their security portfolio. They have positive duration, at least for the median bank, according to our estimates. So they potentially lost money on the security portfolio and potentially lost money on their franchise as rates risen. Where does that leave the banking system as a whole? Okay, so here's this graph. This graph is across the entire banking system. We're sorting across losses on the security portfolio of banks. And then I'm plotting the total value of the bank franchise as a function of the losses on the security portfolio. And what I want you to notice is that this red curve is upward sloping, which is to say that banks with more security losses were banks with higher initial franchise values. Banks with lower security losses had lower initial franchise values. There's a negative correlation in the cross-section between the initial franchise value and the subsequent losses on the security portfolio. That's a useful correlation from the standpoint of stability of the banking system. Why? Because here, if you just look at the cross-section, a histogram of losses on the security portfolio, you get a big tail of negative losses. If you layer on top of that losses on the security portfolio plus initial franchise value, you get a much smaller tail, basically because there's a negative correlation between initial franchise value and total losses. So you shrink losses. So our when we put it all together, our conclusion is that banks lost money both on security as well as franchises. It's not so bad just because there's happens to be a correlation in the data that stabilizes things a little bit better. And then the other point I want to make, and this is, if you want, the conceptual point that we're trying to make here is be careful when you think about the duration of the deposit franchise and thinking of it as a negative duration asset. It isn't once you combine it with the loan asset. For the median bank, our estimates suggest that bank duration is positive, and that has implications for a collection of things from bank risk management as well as regulatory risk management. So I'm going to stop there. Thank you very much for sticking around and asking questions, and I guess I'll stay on and answer any further questions.
Xiao Long, would you like to say your question? Thank you.
Yes, yeah. First, I apologize. I do have 3 questions. They can be very quick. First, I noticed in your presentation, in your long-term solvency model framework versus the short-term solvency framework, the equation you listed there in your slide a little bit different from this in the paper. In the paper, you for the long-term solvency model, you put the left-hand side is pre-market equity equal to, and then you don't have the for the market, you have market security and also market the loan. Can you tell me the reason why? Is there any change in your thoughts about
It's because this is just accounting. The losses on the loan portfolio will show up on the spreads. This is just definition. The spreads include all future cash flows from the lending side.
No, I'm getting that. I fully appreciate your franchise value calculation. That is the last term, PVS parentheses S minus C. I want to get understanding, but better understanding is if we do the purely economic value of equity calculation,
yes.
You want to look at the tangible assets, the value, and minus the tangible liability, and then plus your franchise value. Yes. I fully agree on that one. Yeah. The only things I want to hear is because the change. The second term down here, you only add the market security here, and ignore the market
loans
value change of the loan. Can you tell me why?
Again, you can do it one of 2 ways. What we have implicitly done is we've put it into the franchise value.
You say you put?
We've put it into the franchise value.
Okay.
And you can see that because in the short-term run risk where we've dropped franchise value because it doesn't show up as a source of liquidity, now we have the mark-to-market in the loan book.
Okay. Oh, got it. Okay. Then my second question is, when you do this, you have the 2 multiple equilibrium model here.
Yes.
Could it be possible? You said in the ordinary time, people look at long-term solvency concern, and that's the way you calculate the economic value of equity and see whether it's the bank is solvent or not.
Yeah.
However, when we enter into economic stressful conditions,
Yes.
because of the insolvency fear from investors, uninsured depositors,
Yes.
and the framework may jump from one equilibrium to another. Basically,
Yes.
you may in the short term jump into one.
I agree completely.
Yeah.
So that I think there's a bunch of nice papers that model this dynamics. There's a paper by Muir, Haddad, and Moreira, I think, that models this dynamic shift. We're not doing anything.
My question is that any way you will, or do you have any thoughts about whether you can look at stock market, the banking equity price change, and to see that there is a jump or the transition of framework that is okay. My third question is when you look at the 2023 banking stress period or banking crisis period, if you want to call it, you said you look at the market-to-market security loss and add your franchise value with the positive duration. I'm getting that.
Yeah.
I fully understand that part. But when you do this, okay, and but somehow my understanding is you are using Eric John's
We're using their losses. Yep.
Yeah, using their losses. Yep. Okay. I would just want so you use that security loss only, not including the loan loss, because her analysis are including both. So you just only got the security loss.
We have both, but the graph I'm showing you is the security loss graph.
So you were talking about 2.2 trillion.
In the paper, I think there's a table, there's a graph which has both.
So I want to know, why I'm asking the question is actually there was a paper present that this following last week. The authors were arguing that Eric John's methodology overestimate the losses, the security and the loan loss over
if that's true, we should revisit. Yeah, if that's true, we should revisit this as well. Mm-hmm.
Yeah, they treat the amortization bond, like mortgage, as the bullet bond that potentially overestimate the loss. So that will impact your results.
It will impact our results. Yeah.
Yeah, but even you look at you.
Yeah. Can I just say it's fairly easy, right? Like we've just taken their numbers. We've done a bunch of stuff on franchise value. We've taken their numbers on security losses. We could just replace their numbers with whatever other numbers anyone wants to use, and then we can revisit the stress test.
Yeah, that we did even fewer banks were insolvent during that period.
I'm totally on board with that. Of course, there's other sources of losses that we're not accounting for. We just discussed we have security losses. This picture doesn't have loan losses. It doesn't have CRE losses. There's a bunch of other things that one could account for, which we are not. And to be clear, conceptually, the reason we did this is because we just wanted to ask, what is the source of losses due to interest rate changes? Which is why we did what we've done. And I think this connects also to a question maybe James asked earlier, where we just wanted to think through what happens when interest rates rose, what happened to losses there, and were banks hedged. Of course, in practice, there's multiple sources of losses that banks have suffered, and that's also true, but isn't fully in this analysis. That for a full stress test for the banking system, one should obviously take into account.
Okay, thank you.
Yeah.
Any other questions? If not, would like to conclude here.
Can I just ask a question? Do you
yes,
have any
please.
policy recommendations that arise from your paper?
Let me raise some questions. And I think the question that I've been left with is this question as to what is the optimal way for a bank to hedge interest rate risk, which is a risk management question for a bank and also a policy relevant question for all of you. I think the data tells us that what banks look like is they're doing something like cash flow hedging. And there's two different ways of looking at this. You know, what the data look like is banks with lower deposit betas look like they hold more securities. And there's two different ways you can look at that. One is, it is the case that, say, when banks are doing, say, liquidity risk management or stress testing their liquidity risk, if you're a bank, you will bucket your deposits into different maturities based upon runoff rates. So you might say, oh, I've got a deposit that's running off over the next 3 years. And then if you do interest rate risk management with that same model, you'll tend to want to go out and buy a 3-year bond, because that'll defease your liability. But that's not, I don't think, from a value perspective, that's not correct. Or another way of saying this is, if you have a low deposit beta, that means when rates fall, your deposit spreads are falling, you're getting less cash flow. If you're trying to hedge cash flow, a good thing to do is to go out and buy securities that gain value as interest rates fall. That looks to us like what banks are doing. But that's not the same as value for the reason which we've discussed. When rates fall, spreads fall, but discount rates also fall, so that those two effects offset each other. So from a value perspective, it looks like if you're asking a question of hedging, you go in two different directions if you want to hedge value or if you want to hedge cash flows. That is a question which I've been left with after this paper, and a question for you guys as policymakers is to think about this. What is the right thing for a bank? And you know, if I just put my corporate finance hat on, probably the thing that makes sense is smaller banks may be hedging cash flows, larger banks maybe should be hedging value. That's sort of the usual prescription based on models of financial frictions. But I think really it's a question that's raised rather than an answer that's given.